What the hell you are wearing today, ya Airwalk? We are in a learning session and not in a nightclub in Las Vegas. Your arms are totally naked. Don't you see the thick mustaches on my t-shirt? It is even thicker than the mustaches of Alrez Hanafi, the chief of fishermen in Suez City.
Please forgive me, H. de Boer. All my other modest outfits are in the laundry. Don't be upset with me and start your session about measuring inventory at the lower of cost or net realizable value under GAAP.
I accept your apology. Okay, under GAAP, inventory accounted for using any method other than LIFO in retail, for example FIFO or average cost method, must be measured at the lower of cost or net realizable value.
What the net realizable value is?
As I said in an earlier session, net realizable value is the estimated selling price in the ordinary course of business minus reasonably predictable cost of completion, cost of disposal, and transportation.
How excessive cost over net realizable value is treated?
The excessive cost over net realizable value is recognized as a loss on write-down inventory in the income statement.
Could you please give us an example for applying the lower of cost and net realizable value under GAAP if FIFO method is used?
Okay, Tier and the company accounts for its inventory using FIFO cost method. The following is its inventory information at the end of the fiscal year. Historical cost is $100,000. Current replacement cost is $82,000. Net realizable value, NRV, is $90,000. And normal profit margin is $5,000. You are required 1. To determine how inventory is measured, and 2. In what amount inventory is reported in the balance sheet under GAAP.
To answer the first question, under the FIFO method or any other methods except for LIFO and retail, inventory is measured at the lower of cost or net realizable value, NRV. To answer the second question, NRV of $90,000 is lower than the historical cost of $100,000. Thus, inventory is reported in the balance sheet at $90,000 at the end of the fiscal year. Accordingly, a loss on write-down inventory to the NRV of $10,000 is recognized in the income statement. The journal entry is as follows: debit loss from inventory write-down of $10,000 and credit inventory for $10,000. Note that it is the same loss on write-down recognized under IFRS.
Your answers are correct. Now I would like to talk about measurement of inventory at interim dates under GAAP. A write-down of inventory below cost to market for LIFO and retail and to net realizable value for all other cost methods may be deferred in the interim financial statements if no loss is reasonably anticipated for the year, with 2 considerations.
What these 2 considerations are?
The first one is that inventory losses from a non-temporary decline below cost must be recognized at the interim dates. The second one is that if the loss is recovered in another quarter, it is recognized as a gain and treated as a change in estimate. Amount recovered is limited to losses previously recognized.
What you have just said is about measuring inventory at interim dates under GAAP. Is there any differences between GAAP and IFRS in this regard?
Under IFRS, each interim period is viewed as individually separated reporting period. Accordingly, accounting treatment for inventory measurement in the interim statements is the same as in the annual statements. For an interim period, an inventory loss from write-down to net realizable value must be recognized even if no loss is reasonably expected for the year.